Hi, this is Randy Finney with Right Side of the Chart, and this is a market wrap for Wednesday, November 7th, 2018. We're going to go over the charts, what happened today, but before we get into what happened today, I think I need to make clear what didn't happen today. Just reading comments on Right Side of the Chart from, a lot of the members on the site about today's move. I haven't seen anything like this, how bullish. Let's just talk about what today wasn't, and that is the fact today wasn't anything out of the norm with elevated volatility. Since this thing kicked off in early October, right here, you started this slide here. So let's just look at today's move. So here we are in SPY. We're up 2.10% or 2.1% in SPY today. Another way to measure that, if I use it, and this is what I'll do here. I'm going to show you some of the recent moves. Grab the top of that previous candle right there, the body. That's where we closed, and go up to where we closed today, and you're going to see also it's right there about 2.1%. So let's just take a look at some of the recent moves. Okay, this day from the previous candle, you grab the body down there. There was a drop of 3.17. From there, the bottom of that body to that candle to where we closed that day down there, 2.1%. Now let's see on the upside. We've certainly had counter trend rallies are just as strong during corrective phases. There is a 2.2% gain, so that was a move, a green candle, or yeah, from the close. Again, I'm measuring from the previous close, a stronger move than we had today. And again, you can see I can do this all day long. We go down here, grab the bottom of that, the body of that red candle, because that's where we closed down there, 2 and change, better than that. And again, we can go here and look at a couple more candles, but you can see. So the point being is this, and oh yeah, here's another one here we could check right there. That was that big gap up a couple weeks ago. Now that one wasn't as high, but you follow you get my point here. In fact, let's look at QQQ because that's where the volatility lies. Qs were up stronger today. Nice respective 3% gain. And again, grab the previous candle body there, where we closed, and it shows you there right about a 3 point, a little better than a 3% gain. But again, nothing unusual as far as the recent volatility. There's a 4.4% drop from the close right here the previous day to that following close, 3% gain there as well. So you get the picture. This is really more of the norm lately than anything that's uh, you can take of it what you want. And I will give you, and I'm going to go through this video. I'm going to show you the pros and cons and really what did happen today, and then you can decide where we're going. All right, so that I just wanted to put in perspective that a 2% move in the S&P 500, the broad market, a 3% move in QQQ is par for the course lately. And you can see on QQQ, yeah, closed right above the, right below, or right on really the 50-day moving average right there, that yellow line. And we took back the 200 days. So I'm going to give that check mark to the bulls. But I also say this, and I've said it many times, as far as a lot of these key levels, and that's what we're coming up today, was significant in that aspect that we took out the 200 day. We've been testing that recently, like I said, failed, and we popped above it and we closed above it. But intra-week closes above it and below it lately have been the norm. What's most important to me is a weekly closing basis, and we go on a weekly chart and you use the 40-week moving average. So we'll have to see. Today's only Wednesday, 2 more trading days left. A lot kind of will happen. The farther they park it above the 40-week, and especially this downtrend line, uh, why don't we just, we're here. We're on the weekly chart, so let's just go through this now. So here's what did happen today. We had a nice rally. We regained the 40-week moving average on an intra-week basis. Again, the 40-week moving average, exponential moving average is the same as a 200-day moving average. And we're closed a little shy of backtesting that all-important trend line, which has been broken down. And, I said it back here, and I've said it recently, that you could certainly see a backtest. It'd be my uppermost bounce target. Anything much above that to recapture that trend line, particularly on a weekly closing basis, would certainly put a damper into the bearish case. But as of now, it's really hard to read into this as anything more than just a kickback rally, snapback rally, because nothing goes straight down forever. Let's grab a tool. Okay, so we had one leg down, and maybe this is a one and done correction, or maybe so far this is just a run of the mill counter trend bounce. At minimal, if you're an Elliott wave, you use Elliott wave. You look for corrective phases to have an ABC component at minimum. That would be just a typical run of the mill corrective phase. So maybe this is just a one and done bounce, but again, This is very significant. Not only the fact that we broke that trend line, but when we did it, and on a weekly basis, it was impulsive. Once we closed below there, and then that 40-week moving average, we did it impulsively. So this movie will have to be continued. By the end of the week, we'll know. Like I said, check mark if the Bulls can park it comfortably above, not just on. If you park it right back on there, that's simply a back test. And again, I'm talking Friday 4 p.m. end of week. But a lot can happen. If we have another couple big green days, we can put that in the rearview mirror as well as that trend line, and then it's hard to take anything away from the Bulls if that happens. Okay, now let's take a look at the S&P 500. This is the SPY, the tracking ETF, and here's our very significant bull market uptrend line. The bull market started back in March 2009, and you could have, you can be a little bit flexible with a couple different drawings, and, have this trend line come in at different levels. But here's the way I have it. We captured these reaction lows, kept up above there on a weekly closing base. You can see that green candle dip down below, but back above it. Had another perfect kiss right there and a lot of reactions along here. And so as of now, we're looking at a simple breakdown and backtest of a trend line. So if this was XYZ stock on a 60-minute or daily chart, I would say there's two objective short entries, one on the breakdown below the trend line and the other on the back test. Doesn't mean that we can't get back above there, just that so far that's quite normal to see a breakdown and a back test of a trend line. And again, you can draw this a few different ways, pull it around. You can tighten it up a little and say there's a little more room to go if you want to cut out the bottom of those candles. And then you can also, of course, draw off the 2016 lows. There's a lot of indexes and securities that have that same trend line. But either way, that one still comes in about where we back tested today, give or take. And when I say give or take, it's a weekly chart. So these day-to-day moves, 2-3% above or below, intra-week especially, don't mean much. I'll give it points. So far, we closed above that 40-week moving average, a solid close today above it. But these weekly candles, remember, they're not finalized until Friday at 4 p.m. So we'll see what happens on SPY. Um, Coming down to the daily time frame on the S&P 500 or SPY. Here's that same long-term trend line, so you can see we're just a hair below it. Also worth noting is the this call it 279, give or take 279-ish level, pretty significant. It was resistance, resistance, resistance. Once broken, resistance becomes support. And when we broke down below, we back tested. But see these candles, how they came above it? That's that I talk about during periods of expanded volatility. You have these sharp moves. You're going to overshoot support and resistance levels, and that's what happened today. Now, so take it on face value if you want. That's a breakout. But even if you want to call it that, then you have to include these previous reaction highs, as you should. You should always look at previous reaction highs as potential resistance points. And that's right where the SPY stopped today. So work to be done for both bulls and bears. The bears need to pull it back down soon, not let it get much higher. Maybe want to come back, fill, test this gap. We'll see what happens there. But as of now, like I said, we'll have to see what goes on. So far those divergences they were highlighted before, the divergences on the RSI are playing out. We have the bullish crossover on the PPO. And if you recall, my preferred scenario was and is something like this. Just draw it out here. I'll draw all the lines for you. So we had the divergent low there. We can certainly extend the divergences. What I'm going to do here is extend the divergences. We don't have divergence, never had the divergence on the PPO. Don't have to have a lasting bottom, but it really helps. So there was the divergence in place. And, I'm still leaning towards a scenario like this where we turn around, have another thrust down, come in, and doing so would allow us to put in, or would put in, if it happened relatively swiftly. It all depends on how long it takes to get there because those indicators can change. So then you come back down and you put in a higher low on the PPO, a nice divergent low, do the same on the RSI, and that would set the stage for a nice lasting rally. Again, doesn't mean it has to happen, but it's something to look for and somewhere I'd be really interested in, positioning long for multi-week to multi-month swing trades. QQQ, I have a lot of different drawings, different boards. This one has a couple of fibs. Probably the two most important Fibonacci retracements are the Here, this one, the move down from the highs back in early October down to the lows, as well as this major reaction high. We had a counter trend bounce there, and you can see the fib clusters where two of the lines come in together close. We had a fib cluster there, had a reaction, and just overhead above, you can see we have two fibs. Actually, that'd be a full retracement of that first one, so that's really 100% fib, and then the 61.8% retracement of this move down. So those are fibs, but more importantly than the fibs, at least to me, is this big 178 level. I think it's a pretty important level on QQQ. If you recall from back here where I started, closing out all shorts, going long, getting bullish for a bounce, that's actually where we hit the last official trade, and I closed out the last short trade we had on the right side of the chart. Originally had this target, but then I revised it, said, you know what, I think the bounce is not worth being short anymore. Risk reward is not attractive. We're going to eliminate that target, put profits here. So we sidestepped this mess on the long side, and we actually recycled back in today. I have those targets on another board. That's for members only, of course. That's an official trade as of now. And what I wanted to point out is this 178 level. It's a pretty nice little trading range right there. In other words, it was resistance right here. We have once we broke it, we had support there, quite a few reactions, and once we broke down, we had that impulsive selling that helped to validate that as an important support level. And then you zoom in real quick, you can see that we broke down. So not only did we have the impulsive move down that confirmed that was a very important support level, we had a kickback rally to back test it, and that was the last opportunity to get on board if you weren't short for that nice ride down that we had. And of course, we were able to book most profits down there and get out of the way. So doesn't mean that we can't go through there now. It just means right now you can see a trend line coming in and that 178 level not far overhead. So the way I view all trades, and this is what I said on when I put that trade out there a little before the close today. So far we're in not far off the highs. I said this, that the success rate or probability of this trade playing out is a little below average because the momentum is strong right now on the upside, and we've had a heck of correction. So we took back the 200-day moving average today and some other key resistance levels. So therefore, we may be stopped out, but if we're stopped out, our downside, our loss potential is about 2% from where we entered that trade a little before the close today. We're going to stop out, a little bit over there. I won't give you the exact targets. You can check those on the site if you're a member. But compared to the profit potential, if it plays out, it's well worth it. So some trades I take are what I call high probability trades. If I have a chart pattern, very solid support or resistance level I can go long on. And I'm very confident that trade's going to play out. I would have a high degree of confidence that it'll play out, but my risk reward, my targets might not be as high. My risk reward ratio might not be as good. This one, as I clearly state, I think has a better chance of failing than average, my average trade. But if it does play out, our gain potential is oversized. It's much larger. And if we're stopped out, the risk is minimal. We're talking, like I said, maybe 2% to make a 13% or more on profits. Here's the NQ E-mini futures. You can see I have a resistance zone here. There's some Fibonacci clusters right there. We popped a little bit above it, closed a little bit above it today, but not by a very wide margin. And as most of you know, I love swing trading the 60-minute time frames. I look for these divergent highs, divergent lows. Last time we had one was right here. I highlighted that in advance on the site. Said we ran into resistance. That was one shorting up there. The next shorting up came on the break down below, and that was good for a nice pullback. That ended with, you got it, bullish divergence on the 60-minute time frame. Again, that was pointed out on the site. It had a nice little divergent low there, and that led to this pop. So far, this pop, now, it doesn't mean this move is over, but you can see there is negative divergence. We'll have to turn down soon. The PPO down here is pushing just about an equal high. As long as you have equal highs and prices are making a higher high, that's still negative divergence. So pretty much what this will entail is we'll have to gap down in the morning, open flat or gap down. If we go up much higher, there's still some significant resistance overhead, but it will foil these 60-minute divergences. And remember, divergences are not the be-all, end-all. They're just, an indication of that a trend change is likely. Okay, and here's ES, the S&P 500 E-mini futures. Similar setup there. You have an uptrend line. I didn't draw the trend line. I should have drawn that on NQ. But you have an uptrend line here coming off the recent lows. Really more of a price channel. If you look at it this way, you have a price channel right there. And you have about equal high right here on the RSI and about an equal high as well on the PPO right there. Being that prices are much higher, that is divergence. You're diverging away from your indicators. So again, pending either a gap down or a reversal immediately or shortly after the open, as long as we don't gap up too high. You're looking at a pretty nice setup. That's why I threw on that QQQ short today before the close. You can also see where SPY went. We hit a resistance zone. There's some fib clusters here, and more importantly, that previous reaction high from that other kickback rally. So if that happens to get taken out, we have a major resistance zone on the S&P 500 ES just above. There was a big support shelf there on the S&P 500, and once that broke down, that triggered the sell-off and the correction that we just had. So again, maybe that's it. And if you look at it this way, I talked about an ABC earlier. Maybe that is your A, B, C, but maybe again this morphs into something more like a 5-wave impulsive. Wave one, wave two, wave three, which is impulsive. I don't know. Looking at this count, I'm not big on Elliott wave. It's too subject for revision for my taste to be really useful and predictive. If you keep revising things after the fact, it doesn't do a lot of good. But again, that's just me. I'm sure there's people out there that really focus their efforts on Elliott wave, and they may do a good job of trading that. I'll use it to complement some of my other analysis, but I don't lean too heavy on it. Okay, let's finally wrap it up here. We'll just look, these are 30-minute charts on SPY, and we'll look at QQQ. Just some different drawings, different variations of what's going on. I already mentioned a trend line off the lows recently. You can exclude that little, I like to exclude that little spike there because you had a lot of reactions. It was a brief pop down with snap back above, or you can, if you want, you can draw it there. You have more reactions on this line. So those are things to watch, and it sort of meshes with what I just showed you on the futures. So this gives you a wedge type pattern. There's your divergence, at least on the PPO. RSI is already taken out, at least on this 30-minute chart. There were the golden trend lines. Again, that gave us a lot of shorting ops on the way down. They were taken out, which again wasn't surprising at the time. It was expected, popped above it. And on QQQ, let's go there and we'll wrap this video up. QQQ, the golden trend line, a lot of failures, finally a breakdown. We recently back tested the other day and we moved up. So you can do the same thing on this 30-minute chart. And again, it's stretching. The indexes are stretching these divergences right now with roughly equal highs. I didn't make that line exactly parallel, but I think you see what I'm saying. Sometimes you don't have to split hairs on these things. If the lines are slightly, upward sloping or not, you can still get the divergence. So that's it. We have those previous reaction highs to contend with on QQQ as well. I mentioned SPY closed right about there. QQQ has a little more upside. And then that's it. So let's see how we close the week. I don't think it's time to be getting too aggressively long or short. If you're already long, trail it up. It all depends on your mindset right now. If you believe that that was a correction that's over and this market's going to new highs in the next 10 to 20%, it's to the upside before the downside, then you buy the dips at this point. If you're of the mindset that these longer term developments on the weekly and daily charts are more significant, then if you recall back of just a couple weeks ago when I started getting bullish, looking for a bounce here, I listed and I can't remember which chart I had it on. I had a bounce target range, bounce target zone, which runs up to, again, that's not on this one, it was about 178, my uppermost bounce target on QQQ. And I said I would scale in up to, but not above the 178 level. I don't think it's worth adding because at that point, I think the case that this is just a counter trend bounce with another leg down to come is quickly eroded as QQQ if and as it goes past 178. So where we were today, I think I put that trade on at 175 even. So I think 175 up to 178, that's pretty good. I think scale in zone for a short. Because like I said, look at your risk reward. What if you're wrong? You're going to lose maybe a couple percent. And if you're right, a lot more than that. And if you are bullish and long, well, look at all these levels. Just look for these reactions. We have a lot of Just like we have quite a bit of support above, we have a lot of resistance below now, and you can use those resistance levels to go long on pullbacks if that is your expectation. And finally, to leave it at this, if you don't know what to do, whether to be long or short right now, the best trade is no trade at all. There are certainly some mixed signals. It would have been ideal to see a rejection if you're, looking for the bearish case, that is, a rejection off the 200-day moving averages and some of these overhead resistance levels and to see any counter trend bounce fall short at the shorter end of Fibonacci retracements and things like that. So the more we go up here, the harder it makes, the more it chips away at the bearish case. And if we didn't still have so many key uptrend lines and price resistance levels overhead, it might be time to go long and get bullish, and maybe it is for you. So whatever you do, long or short, the key to success in this game is just use stops. If you're whether you're going long or short, trail your stops up or set stops. Maybe raise them to break even once your trade gets profitable and let it run. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.